Hello everyone and welcome to this month's webinar. Today we're going to be talking about a topic I get this question all the time. So I've been trying to do this video for a while now. It's harder than I thought, but anyhow, I'm going to have a crack at it today. It's all about whose name or what name should your investment property be in. And we're going to be focusing today on residential investment properties. I'll do another one later on commercial properties, but today we'll be focusing on residential. Just before we get started, there's a disclaimer to make sure you get your own independent legal and accounting advice, particularly when it comes to property ownership and things like that. Obviously from a tax side of view, I can give you all the advice you want, but if you need things like asset protection and things like that, lawyers are always good for those sorts of things. And there's me, I'm Derek Nolan, I'm the owner of 12 Chartered Accountants, been doing these videos for a long time, so make sure you go and check out all the other ones. So when it comes to deciding what name or whose name should investment property be in, well, it's not easy. It's not a simple answer. And a lot of people ring me wanting a simple answer. But there's a lot of things to consider. Now, I know most of my clients fairly well, so in a way I can sort of give them an answer which sort of best suits them. There's a lot of things you need to consider. Obviously, your personal circumstances, the tax situation is always important because investment properties, everyone knows there's a tax element. The revenue comes in, there's negative gearing issues, and obviously when you ultimately sell the property, you need to be aware of the capital gains tax situations. And there's land tax and stamp duty issues and a lot of other things. The big thing, this is probably not the world of the accountant though, is asset protection. This is where, obviously an asset is an important thing. And if it's in your name or your business's name or anything like that, there's always issues regarding asset protection and being sued and divorce and all those other things. So that's where a lot of good advice would come from lawyers. But we'll go through a few of those things today. And obviously your long-term goals. A lot of people come to me wanting to buy an investment property. They haven't really thought it through a lot and they don't really know what the ultimate outcome of it is. So they're all the different things we need to sort of consider to answer the ultimate question on whose name should it be in. So what we're going to talk about today in this video, so we're going to talk firstly about the different options. So when you buy a property, it can be in your own name, your joint names, it can be a company, a super fund, a trust, lots of different things. So we're going to go through all the different options first. Just explain the good bits and the bad bits about each of those options. Once we've done that, we need to talk about the questions you need to ask yourself. Or the way I look at it is when someone rings me up and says, Derek, what name should I put it in? Well, these are the other questions I'm going to ask them first before I can then even attempt to try and answer the ultimate question for you. So we'll go through those questions, about half a dozen to a dozen of those as well. And then at the end of the video, I'm sort of give my final thoughts on whose name or what name should the investment property be in. So let's get started. So there's 6 options. Now, there are many other options, and I'm sure in the comments below, people will mention things like testamentary trusts and joint ventures and other things like that. But we're going to stick to the 6 main options today. And we'll have a different slide on each of those, but you can go from a personal name to a joint name, could be a number of people. Trusts are very common to own property in, and that could be either a family trust or a unit trust. Companies, you don't get a lot of properties owned in companies, but every now and then you do. And the last one that we're going to talk about is the self-managed superannuation fund. So they're the 6 options that we're going to stick to today. And like I said, you'll come across other combinations of those. Particularly, you might have a situation where you have a joint venture or a partnership between a person and a super fund. Or you might have a combination between a unit trust and a company. There's lots of different variations from that, but we're not going to go through those too much today. So go through each of these options. The first one we're talking about is in your personal name. So this is when you buy a property and on the title, it's just got Derek Nolan. Owner of the property, Derek Nolan. Simple as, and that's probably what one of the good things about this is it's simple. It's easy to understand, low cost, low administration. It's very simple and straightforward. And most properties are sort of bought that way. And a lot of people that are looking at buying an investment property, they've probably already purchased their home where they live in. So they've probably been through that process. In most situations, there's occasionally there's a reason not to. But in most situations, your family home will be owned in your personal name or personal names. So you're sort of used to that. The other big advantage is negative gearing. So at the moment, negative gearing is still all the rage. The tax office, allow people to, have a loss on investment property, which is great for tax. There's other things you need to consider there about depreciation. Obviously, you can claim your interest and all your, costs of the property. Show your income. If there's a minus there, that helps you in your personal tax return for tax purposes. So that's nice and easy. The other great thing is, well, not a good thing, is that one day you'll sell this property. You might not, but your children may inherit the property and they sell it. So at some point, capital gains tax raises its ugly head. But the great thing about in your own personal name is that you qualify for a 50% general discount on any capital gain. Now, many years ago, that capital gain was discounted by indexation to inflation. But about 1997, they got rid of that indexation and just replaced it with a flat 50%. So instead of having to worry what the CPI was every year, if you have a $100,000 gain on investment property, you only have to pay tax on 50% of that, which is great. And the other thing there is when you go and borrow money, this is not a tax thing, but just borrowing money, going to the bank, it's a lot easier to understand, very straightforward. Most loans are done by banks in individual names. So the property's in your name, the loan's in your name, and it's very straightforward. So there's some of the good things. On the flip side of that, this is probably the main thing. Again, it's not a tax issue, it's more of a legal thing. You don't really get any asset protection if an asset is owned in your name. Now, most of my clients are business owners. So every day of the week, they're living in a world of when's something going to go wrong? When are they going to get sued? When there's going to be some risk associated with anything they do. Now, they always get advice to run their business, through companies, have family trusts, all this, as much asset protection as you can, take all the insurances you like. But at the end of the day, though, if someone's going to sue you and somehow can get to your personal assets, and you have investment properties in your own name, well, they're at risk. So having your assets in your own name doesn't give you the asset protection. And some people, this is a really important thing for them to do that. So we'll touch on that and how important that is for some people. And other things, we talk about capital gains tax, is that when you have a property in your own name as an investment property and it goes up in value, and then you ultimately sell it, sure, you get the 50% discount if you own it for more than 12 months, but that capital gain is going to your own personal tax return. There's nothing you can do about it. And that's pushing you, if you're already earning $190,000 from other income, and also you've got this capital gain, it's like a cork that floats to the top of your tax return, you've got a lot of tax to pay, sometimes at 47%. So that's always a bit of a downside on that one. So they're the pros and cons of owning in your own name. A slight variation of that is joint names. And again, people that bought their own home with their spouse, they sort of understand that there's two people on the title. I'll go through a couple of points regarding being joint owners and tenants in common in a sec. But if you've got investment property, which is what we're talking about today, and there's two owners, it does give you the ability to split the income a little bit, particularly if the two owners, husband and wife, there's different income levels. So it does give you that ability, although in most situations, well, in all situations, the percentage of the income is locked in. it's either 50-50 if you're joint, or if you're in tenancy in common, there's a percentage that's always been established, whether it's 90%, 10%, 50-50, 60-40, whatever it is. Not a lot you can do, but a lot of people can sort of manage their affairs and maybe sort of have the ownership to match the income. Again, like an individual, those two joint individual names can get the 50% discount on the capital gains, which is good. And the same thing, it's fairly cost effective to set up ownership in two people's names. It's no different to in one person's name, so it's fairly straightforward. Just a point though, when you buy a property in joint names, it can be either joint names or tenants in common. Now with joint tenants, it's just 50-50. And again, a lot of home that you're going to live in is bought that way. It's nice and easy. Everyone sort of knows where they stand. It's just joint tenants. And the difference that is tenants in common. And on the first page of every contract, there's a box to tick. Is it joint tenants or tenants in common? With the tenants in common though, you then get to choose what percentage. Now it might be 50-50. It might be, in my situation, when Anita and myself bought the house that we live in, it was 1% Derek and 99% Anita. And we did that for asset protection purposes and things like that. We won't get into that today, but that was for our home. So it's not really a tax thing. I've seen clients where they go and buy a property and they know it's going to be significantly negatively geared, particularly with high interest and high depreciation rates. They might have a $20,000 loss. And they're projecting that loss to be around for the first 4, 5, 6 years. So buying it as tenants in common, they could sort of load it, particularly if the income of the two people is significantly different. So if it's negatively geared, you might want to have that person own 90% of the property, for example, or 99%. So therefore they get a bigger percentage of the losses, which really helps with the negative gearing. Now, on the flip side of that, unfortunately, over time, is the rents go up, the interest rates go down, so therefore that negative could turn into positive, which is not a great thing. Well, it's good for cash flow purposes, but ultimately you may have to sell that property and make a big capital gain, and then all of a sudden you've got 90% of the capital gain in the highest earners tax return, and you're paying a lot more tax. So sometimes you need to look at the opposite and say, listen, what we're going to do is put the higher percentage in the lower income earners' names. That's what I normally recommend people to do. But at least under joint names and tenants in common, allows you to have that flexibility. So you can do that. And joint names doesn't have to be two. It can be 3, 4, 5, 6 people. Doesn't matter. It's quite common now for parents to buy a property for their child. And it might be, 3 people on the title then, mum, dad, and child, 30%, 30%, 40%, or something like that. That's quite common. So on the flip side, this whole fixed ownership, though, you might have done it 90-10 to start with for really good tax purposes, but then you're stuck with that. And time will erode those benefits, particularly with the capital gains. It's sort of, again, it's a fixed arrangement. And again, the same as before, you've got this asset risk, but potential if you get sued and things like that. But again, this is where you can do that. Like in my situation where I've got 1% of my house, I did that when I was in a partner in the city, and there's a risk every day. I didn't want to have too many assets in my own name, so therefore if someone was to sue me, they would get 1% of my home. So you could think about that as well, where your spouse who's in a lower risk, maybe they're not in business, can own the higher percentage, but you're still on the title. So there's a few things to consider there. There's a few things there regarding relationship risk and divorce and things like that to consider. Now, family trusts. People love talking about family trusts and owning investment properties. And I must say, when we go through some of the questions later on, it does tick a lot of the boxes, because those things we just talked about, where in your own name or in joint names, there's no flexibility there. All of a sudden, a family trust gives you lots of flexibility. So this is what it's all about. So accountants do love family trusts, not just for property, for businesses, for other investments and things like that. I've done videos on this before, and I'll show you a link to one before, but it's all about, if the income comes into a family trust and it has to be distributed, the trustee all of a sudden has the ability to share that income where they want it. So in a particular year, you might want to give income to, from the rental property to people in lower income levels. Like if William and Richard are still at university, I could give them the income that year. Same things when there's a capital gain, you've got more humans to be able to give the distributions of the capital gains to. The 50% flows through to them. So it's a really fantastic thing to be able to use for tax purposes. The other great thing that people like family trust for, it does give you some asset protection, particularly if, and I'll go through the video I went through that I'll show you later goes through this a bit more, is that when you set up a family trust, normally the beneficiaries put the money into the trust. Let's say you put $1 million into the trust, and the trust then goes and buys an asset for $1 million, and then the income comes and gets shared around. And you can show that money that you lent the trust is just a loan. So therefore you can take that back whenever you want. So therefore it doesn't really give the asset protection, because if I lend money to the Nolan Family Trust and can get it back whenever I want, a creditor could come and still take that money. But the way around that is for me to gift it to the family trust. So therefore I gift the $1 million to the Nolan Family Trust. It goes and buys investment property. It's not my money anymore. It belongs to all the beneficiaries. So if someone comes and sues me personally, they can't get that $1 million because it's not mine anymore. So that's why the trusts give really good asset protection purposes. So asset protection, tax flexibility, it ticks a lot of the boxes here. Again, lawyers love this for estate planning, because all of a sudden you've got this entity that doesn't die. The beneficiary may die, Derek Nolan might die, Anita might die, but the trust lives on. So therefore, it goes into different generations of assets. And the other great thing here is that when the income comes into the family trust from the sale of the property, if it then flows through to individuals, because it doesn't have to. Family trust can actually make distributions to companies, by the way. But if it does make a distribution to an individual, they still get the 50% discount. So it does flow through the family trust. So that's a really good thing. So like I said, the family trust ticks a lot of the boxes when it comes to owning investment properties. Now, on the flip side though, is the negative gearing. It's sort of trapped, because this is a fundamental thing about family trusts, is they distribute profits, but they don't distribute losses. So therefore, if you've got a negatively geared property, $30,000 worth of rent comes in, you've got $40,000 worth of interest, another $10,000 worth of other costs, $10,000 of depreciation. That $20,000 loss, if it's in a joint names, can be split 50-50 or 90-10. If it's in your own name, it goes in your tax return and saves you tax immediately. But the trust can't distribute those losses. So that $20,000 stays in the trust. And then next year you might have another loss of $20,000. Now we've got $40,000 worth of losses. So the losses stay there until it turns it into a profit, which may be 3, 4, 5 years down the track. So you don't get the immediate sugar hit of having a negatively geared property in a trust. What happens over time though? That trust can own 1, 2, 3 properties. So one becomes positive, and then it can buy another one which is negative, and the two can offset. So you might have a $10,000 profit in one and a $10,000 loss in the other one. They can be netted off, so there's no income to distribute. But that's a common problem with trusts, with this whole negative gearing issue. The other thing is trusts aren't cheap. Like I said, the simple thing about owning it in your own name or in just people's names, it's very simple to set up. If you have a family trust, all of a sudden you need to consider, do I need to have a company as the trustee? What's the annual accounting fees? What's the setup fees? There's stamp duty, there's legal costs, all that sort of stuff. Now, because it might cost you $2,000 or $3,000 just to set it up and another couple of $1,000 a year in accounting and legal fees. So it does become a little bit expensive to do. And again, if you're borrowing money in a family trust, it's a bit more complicated because you go and talk to some, young mortgage broker and they get a bit confused about borrowing money into a family trust, and banks do get confused, and it's not as easy, that's all. And the other big negative, and been through this with other videos, is land tax. So most states, we'll get into the land tax later on, but most states have this land tax, and individuals get a threshold in most states. And we'll go through some examples later, but family trusts don't. Except for Queensland, they get a small threshold for land tax, but all other states, they don't. And when it comes down to doing the maths on it, all these good things, land tax is always the killer. It always ruins the party when it comes to owning property in a family trust. We'll go through some more discussion about that later. Option number 4 is a unit trust. Very similar to a family trust, but the difference between a unit trust is the beneficiaries in a family trust is completely at the discretion of the trustee of who gets the income. So if I've got $10,000 and I want to give it $5,000 to William and $5,000 to Richard, I can. But a unit trust is different. It has a lot of the same characteristics, but the beneficiaries have an entitlement. And that entitlement is sort of locked in stone. So if there's 5 unit holders and each of them own 1 unit each, well, therefore, they all get 20% of the profit, and there's nothing you can do about it. That's the way it's got to go. So the unit trust is more, well, like I said, it's very commonly used for property developments, particularly when a number of people are pooling their money together. So there could be 3 or 4 people all throw, $200,000 into a unit trust. So they've got $1 million there. They go and do the development, sell them off, and everyone knows exactly where they stand with the profit distributions because there's no discretion at all. So like I said, the unit holders know exactly where they stand. And then the unit holders have to deal with their own tax. So if there's a unit trust and there's 5 unit holders, and one of the units is owned by a company, one of them's owned by a family trust, one of them's owned by Derek Nolan, one of them's owned by someone else, well, I deal with my own tax. 1/5 of the profit comes to me, I deal with it. I don't care what everyone else does. So everyone sort of knows where they stand, but they deal with their own taxes, which is a really cool thing to do. Again, it gives me asset protection. Sort of. Like if I go and put $250,000 in and buy a unit for $250,000, I guess that's still an asset of mine though, but the actual building, as long as it's still in the unit trust, I don't own that. I own the units in the unit trust that owns the building, but I don't actually own the building. So there is a little bit of asset protection there. Not as much though as a family trust where you've gifted the money. The other good thing about this one, this is what separates a family trust from a unit trust, is the whole land tax. Because land tax for a unit trust, the Office of State Revenue looks through the unit trust to see who the unit holders are. And if they can see that the majority of the unit holders are individuals or companies or a self-managed super fund that is entitled to land tax thresholds, therefore the unit trust then gets a land tax threshold. But if any of the unit holders are family trusts, they don't. So just don't make sure that the unit holders aren't family trusts. So therefore the land tax doesn't become as big an issue as it was with a family trust, which is a pretty good thing. The other thing why I like unit trusts is that if you've got 5 people pooling money together to buy a property, not only do you sort of get a bigger property because you can go buy a little one yourself, but you sort of pooled your money. But if you go and borrow money to buy units in a unit trust, for tax rules, you can claim the interest against your revenue. Or if you're buying it for capital gains purposes, that interest can be claimed against the capital gain. where someone else in the group that buys the units, they might not have borrowed the money, so therefore it's not an issue for them. What could also happen is you could all pool the money together, so there's $1 million there, and then the unit trust goes and borrows money as well, borrows another $1 million. So the interest becomes deductible for the unit trust. So it's a lot easier to either claim the interest in the unit trust or your personal name on the borrowed money than it is with family trusts, because there's no direct entitlement. So therefore, if you're borrowing money and putting into a unit trust, into a family trust, there really is no tax deductible portion for it because you're not entitled to anything. So the interest deductible, if you're borrowing money, is really a cool thing there. Again, on the flip side, like most things do, it's not very flexible. Where we talked about here, everyone knows exactly where they stand, which is a good thing, but it's also not very flexible for tax purposes and asset protection and things like that. And again, the same thing as a family trust, the negatively geared side of the investment is trapped in the unit trust. So until it starts becoming profitable and uses up all the losses, there's no real distribution. You don't really get that tax credits, and a bit of a sugar hit to start with. The next one is company. Now, this is not very common for investment properties in particular to be owned by a company. I'll go through why in a minute. Again, it's fairly straightforward though. You have a company which is a separate legal entity. A lot of people understand that, and all the business owners out there watching this understand what a company is all about. It's all about asset protection. Now, some people think companies are all about tax and stuff like that, but it's not. It's all about you running your business through a company, and somewhere in your structure you have this company. So if someone sues your business, they're suing the assets of the company and not you personally. But what a company does, it does compartmentalize your assets. So what you can do if you're running a business, you might have a company over here that owns your assets, another company over here that is your operations. So therefore, by having those two things separated, if something goes wrong with this company over here, the one over here owning your assets is safe. And the assets might be your intellectual property, your trademarks, your cars, your equipment, things like that. So same thing here. There is a world where you go and buy an investment property in a company, because it's all about then protecting the asset, which is the investment property. A lot of people think, well, hang on, what we'll do is we'll own the property in our own name and keep all the liabilities away by using companies and stuff like that. But some people go, no, let's do it the opposite. Let's put all our assets in a company where it's protected and all the risks are outside. So therefore, if I get sued, no problem, it's in a company. Now, there's some issues regarding, family law courts and creditors and things like that, but it is an option. And that's what it's all about with a company. It's all about asset protection. That's the number one thing the company will give you. Now, another thing is people get pretty excited about companies having a flat tax rate of either 25% or 30%. Now, in this situation, if you've got a company that only has an investment property which is passive, therefore the tax rate will be the 30%, not the base rate 25% for active businesses. But 30%, you might go, well, 30% is still pretty good, better than 47%. But at the end of the day, it doesn't really work that way, because even in your own name, and you're paying the capital gains tax at 47%, after you get the 50% discount, it's really only 24%, 23.5%, which is less than the 30% for the capital gains. Because as I'll explain in a second, companies don't get a 50% discount. But for the rent coming in, happy days, because you've got a property and it's got rent coming in, maybe it's a gain of $20,000 for the year. If that $20,000 then flows into your own tax return, well, you'll be paying tax at the highest tax rate of 47%. In a company, it's 25 or probably 30%, much lower. So tax can be a reason for setting up a company. But again, investment properties, it's all about capital growth. But there are times when you're buying investment properties where it's all about yield. You're not really looking for the capital growth. You might be looking in country areas with really good rent returns. So therefore, having it in a company isn't a bad idea. Um, no tax issues. I don't know what family tax issue. I'm not sure what I mean by that one. Now, on the flip side of that is what we talked about before. Companies don't get a 50% general capital gains tax discount. So whatever it makes as a profit, if it makes a $500,000 profit, it pays the full tax at 30% on that profit, as opposed to flowing through to someone's personal tax return. And even if it's at 47%, they get a 50% discount, so that's really only 23.5%. So there's quite a significant tax savings there. And the second thing, if the capital gain goes into the company and you pay the 30%, then you've got to take it out as a dividend, and you may be paying at your 47% tax rate anyhow. Sure, you get the 30% franking credit, but you end up paying the difference. So you end up paying at 47% and get no discount. So ultimately, that's why most people will put a line through the option of buying investment properties, residential or commercial, in a company's name. It just kills you. So you got these capital gains tax issues everywhere you look. So most people don't do that. There is some flexibility with the income distributions when you give the dividends. So there is an option there where if you've got lots of humans who you can make distributions to, either through the shares and stuff like that, there is a possibility, but at the end of the day, they still don't get the 50% discount. So it's quite inflexible. And if you start changing the shares too much, there's stamp duty issues as well. And again, set up a family trust is complicated, but a company is even more, because you're now dealing with ASIC, and you've got directors' fees, you've got director ID issues and financial reporting and stuff like that. Okay, and the last one we're going to go through is, again, another favourite one of mine, is self-managed superannuation funds, becoming very, very popular to own property in self-managed superannuation funds. Now, the tax benefit here, that's what it's all about, is that the income in a self-managed superannuation fund, the rental income is taxed at 15%. Now, the capital gains is taxed at 10% because super funds don't get a 50% discount, they get a 1/3. So 1/3 of 15 is 10%. But the thing about self-managed super funds is that when you're in accumulation mode, that's when the 15 or the 10% tax has been. But once you turn 60 and then you move that into a pension phase, the tax on that is 0%. And that's why people are going, wow, that's why I go, why didn't I buy my investment properties in my self-managed super fund? Why did I put them in my own name, 10 years ago? If I'd known this, I had my time over again, that's where I'd be putting them. So self-managed super funds are becoming very popular to own property because of the tax side of it. The flip side of that, though, is how do I get money into super to buy the properties? Well, a lot of times people are going to have to borrow that, and there's a few issues regarding that. Another great thing about self-managed super funds is the asset protection. Once inside of a superannuation fund, it's pretty protected. Now, obviously not from divorce and things like that, but from most creditors, your superannuation's fairly safe. So therefore, self-managed super funds, again, anything to do with your retirement, you need to be fairly careful with. Long-term retirement strategies, investment portfolios, and things like that should be considered fairly low risk. So therefore, low risk, low tax effective, all those sorts of things. It really is a great strategy for looking after your retirement. The downside of a self-managed super fund owning a residential property, which is completely different to a commercial property, we'll do another video, like I said, on commercial property, is that residential property, the members cannot use that property at all, or their relatives, or even their friends in a way. So if you've got an investment property in a self-managed super fund, you must rent it out to someone that you don't know. Like, it must be rented. You can't use it as a holiday home. Your kids can't live there. Your parents can't live there. You can't live there. You can't even use it at any point. So that's always the downside. There's also other issues regarding self-managed super funds, is that a self-managed super fund can't buy a residential property off a member or a related person. And a self-managed super fund can't sell an investment property, a residential, to a member or a relative. But it can with commercial properties. Don't know why the tax office have done that. I guess you can't live in a commercial property where you can in a residential. But they're the rules. So there's lots of superannuation rules you need to follow, but the tax side is always a great benefit. Same thing with self-managed super funds though. There's no negative gearing benefits. But at the end of the day, there's not a lot to save. If you're only paying 15% tax or 0% tax in pension mode, there's not a lot to worry about if it's in negative gearing. But again, going back to the original option of putting in your own name, and there is a significant tax savings there, being in negative gearing, you do get money back, which is a nice thing to do. So a lot of people think, well, hang on, what I'll do, I'll buy it in my own name to start with while it's nice and negative, and then I'll transfer it to my superannuation fund. And this is the problem, you can't do that. A member can't sell a residential property to their self-managed super fund. They can do a commercial property, and that's not a bad strategy to do that in the early days. Own it yourself and then sell it to your superannuation fund. We'll get onto that another day. Going to the world of self-managed super funds though, very strict guidelines. They need to be audited every year. You need to follow the SIS Act. There's lots of things. It becomes quite expensive. And particularly if you want to start borrowing money in a self-managed super fund, you have to have a bare trust, or what they call it, LRB, a loan agreement, which is separate companies. The trustee of the super fund needs to be a company. So just the setup costs alone could cost you $5,000 or $6,000, let alone the borrowing in a self-managed super fund, because none of the big banks touch it. You're dealing with Liberty and Latrobe and Resmac and other lenders like that who are charging 1%, 2%, 3% higher than the standard variable rates. So it does become quite expensive to buy a property in a self-managed super fund if you have to borrow. But if you don't have to borrow, if you've got the money in the super fund, it's a pretty good option. Okay, so before we go any further, I'm getting carried away here with the time, but they're the different options that you have. And like I said, once you understand what your options are, well, you now need to start, well, hang on, how does each of those things affect me? So you need to start asking yourself these questions. So I've got a list of questions here that you should either, I would ask, your accountant should be asking, your lawyer should be asking, or you should be asking yourself these sorts of questions. I'll go through these really quickly, but I've got another slide on each of them as well. So the first one is why. Why are you buying the property? Is a really good question. Number two, do you have the intentions to live in the property now or in the future? And this includes any relatives of yours. Really good question, because there's stamp duty issues, there's capital gains issues, the whole self-managed super fund thing, which we talked about. So those sorts of the questions are really important. What state is the property going to be in? Like we talked about, there's different issues regarding stamp duty and land tax in particular. So you need to know what state you'll be looking at buying the property in. Another important question is, how long do you intend to keep this property for? Is this part of your retirement income, or is it a quick renovate and sell again? So those sorts of things are really important. Another question is it a property development? Is it an old house on a big block of land that you're going to knock down and build some townhouses on, or a duplex, or is it going to be a quick property flip? Those sorts of questions. So if someone rings me up and say, Derek, I want to buy an investment property, whose name should it be in? That's one of the important questions is, what are you going to do with it? Why are you buying it? How long are you going to keep it for? So all these questions need to be asked. A few other ones is, do you need to borrow money? Like what I talked about before. Some of those options have much easier ways to borrow money. Otherwise, like the self-managed super fund, can become quite difficult. Another good question is, do you have any other investment property? So most of my clients, I would probably know if they have or not. So one is that if they're quite a sophisticated investor, they've done this a number of times, it's not as daunting to go and set up a unit trust or self-managed super fund or anything like that. If it's their first one, it's always nice and easy just to sort of put their dip their toe in the water and just own it themselves and things like that. But also stamp duty and also land tax becomes a big issue because each person only gets the threshold per person, not per property. So it's really good to know, things like that. Another important thing is how old are you? Obviously I sort of have a bit of an idea on most of my clients how old they are, but this sort of rolls into how long you're going to keep it for and when are you likely to sell it. Another good question is how many people are going to be involved with the purchase? Is it just you? Is it you and your mum? Is it you and 5 other people? How many people are driving this vehicle that we're going to head off into the property purchase world with? So there's sort of 9 questions off the top of my head I came up with that you should be asking yourself. So I'm going to go through each of those quickly because I'm running out of time and talk about why those things are important. So why are you buying the property is a really good question. Now, a lot of people come to me and say, Derek, it's for tax purposes because I've been told if I buy an investment property, I save tax. That's all it is. But obviously, the reason it's going to be negative geared is because it's going to cost you money. But at the end of the day, the reason most investors are willing to spend money or lose money in the early years is all about capital growth. They're in it for the long term, and that those losses in those early years will be offset by the capital gain. So people sort of get the whole tax concept, but I do say for people, if you're just buying for tax purposes, that might not be the right reason. You really got to be looking at those other long-term goals and things like that. Just don't go and start rushing off and buying as many properties as you can to save some tax. Another question is, well, why are you buying it? Well, it could be for a family member, particularly a child. So you might be looking at an investment property, somewhere relatively cheap or near the city or somewhere like that you might be able to put a tenant in. But your long term is it might be near the university where hopefully your kids are going to go to university. So maybe they'll start living there. Now, that's important to know because obviously when they're living there, you're not getting much rent coming in. Or if it's in a self-managed super fund, they can't go near it and things like that. So it's really important to know why people are buying this investment property. And I get this all the time. It's, yep, Derek, I'm buying investment property because my brother's got 5. Maybe not 5, maybe 10, but anyhow, they feel like, well, he's doing it or my friend is doing it, so therefore I must be doing it. So those people are usually quite uninformed about how the whole property system works and things like that. But we need to be encouraged, but explain, what's the purpose of buying investment property is all about capital growth and things like that. Like we talked about before, the second one was, do you have any intentions to live in the property, which includes relatives? So the main reason I need to ask those questions is, well, under a self-managed super fund option is crossed out because that's just not permitted. The other reason that might then become not a good option is under trusts and companies, you can't claim the main residency or the principal place of residency exemption for land tax and capital gains tax. Now, you might have an investment property that you go and live in for a while and then you rent out. So I've done videos of this on the 6-year rules and things like that. Or you might rent it out, then move it into it, becomes your principal place of residence. The capital gains tax and land tax issues and things like that, it's in your own name. Or if joint names. But under a trust or a company, you can never do that. So if that's really what your intention is somewhere in the future, is that you or a family member is going to live there, well, it sort of eliminates the companies and the trusts and the superannuation funds as an option and really only leaves yourself or jointly owned as really the only options. I said that only becomes individual and joint owners. And again, stamp duty becomes an issue because in most states there's some really good concessions for first home buyers if that's your first property that you can buy, and things like that. Oh, and again, last thing there is you get better loans if it's going to be in your own name. So you might have the intention of being a investment property, but you might want to live there to start with to get a better loan. Some banks will give you a 1% discount if it's an owner-occupied loan. So you might just want to do that to start with. The next question is for the state. Well, we talked about this one was all about land tax. So for an example here, every person gets a land tax threshold in New South Wales of $1,075,000. And that's the land value, not the property value. You might buy a property for $1.2 million, but the land value might be $900,000. And every person gets that threshold. So if you own two properties and the land value is $600,000 on both, you add those together, you get 1.2, and it's the bit above the $1,075,000 you pay land tax on. But for example, in Victoria, the land tax threshold down there has been drastically dropped down to $50,000. So on the other important thing there is your principal place of residence where you live is exempt from land tax. So therefore, if you're going to live in that to start with and then rent it out, you may be able to claim the 6-year exemption for land tax purposes. It depends on where you live after that. But when you start thinking about it, particularly when it comes to family trusts, because I said family trusts don't get the land tax exemption, the threshold. So therefore, if you're going to buy a place in Victoria, where if you buy in your own name, you get this $50,000 land tax threshold, which is not much in the grand scheme of things. So like I said, buying in a family trust ticks a lot of boxes. The land tax is always the awkward one, but in Victoria, it's not that big a deal. You're not really going to save that much by having your own name, where in New South Wales, you can save a significant amount of money. You can save at a rate of 1.6%. You can save like $18,000 a year in land tax by having it in your own name, or a company, or a self-managed super fund, or a unit trust, all those other entities that also get the threshold. So you're a company, by the way, gets the threshold, but you only have one company that you own. You can't have multiple companies. Self-managed super fund gets the threshold. A unit trust gets the threshold if the unit holders are individuals or not a family trust. So there are multiple ways to get this threshold, but a family trust just doesn't. Okay, so that's really important. Now, obviously in Queensland, it's a little bit different because I think the individual threshold up there is $600,000, but a family trust actually gets a $350,000 threshold in Queensland. It's the only state that the family trusts sort of get any exemptions. So again, when I ask someone, where are you going to buy? And they say Victoria, probably get a different answer if they said New South Wales or Queensland. So it's really important to know what state. The other thing about land tax, it doesn't cross the border. So you might go and buy a couple of properties in New South Wales and your land value goes to $1 million. Then after that, it doesn't matter because you're going to be paying land tax on the next property. But you go, well, hang on. The next one's going to be in Queensland where I get a $600,000 land tax threshold. So they tried to do this a few years and try and merge the thresholds between states, but that didn't work. So you get $1 million threshold in New South Wales and a $600,000 in Queensland. So all of a sudden, your options can be moved around a bit. So that's good to know. And stamp duties can vary from state to state. So it's always good. There's some concessions and things like that, depending on what state you're buying the property in. So it's always good to ask that question. Another question I love to ask people, well, how long are you going to own this property for? Because it's all about capital growth. So long term is what property is all about. That combination of time and property is always a really good combination. So therefore, when you start looking at it, if your long term is, I'm going to hold it for 10, 15, 20 years, or whatever it is, and by the time you even think about selling it, you're going to be older than 60 years old. And in a self-managed super fund, that's what it's all about, is that when you turn 60, you can turn your super fund balance into a pension mode and the capital gains tax becomes zero. So you might have bought a place for $100,000 and it goes up to be $1 million. So that $900,000 gain, if it's in your own name, you got to pay tax on that $450,000, 50% of it. Now, in a self-managed super fund, yes, you would have to pay tax on the $450,000 as well, but in accumulation mode, it's only 10%. But in pension mode, it's 0%. You can't beat that. So all that capital growth that had happened before you turn 60 just disappears overnight. So if I had my time over again, the investment properties I have in my own name, I would love to those to have been in a self-managed super fund, because now here I am 58, not far away from being 60. It's to the point where I can't afford to sell my investment properties, because whatever I'm working and that capital gain is going to be up here in the top tax rate, I'm sort of stuck with owning them. So that's why I ask people, how long are you going to keep that property for? Because really, if you're going to own them until you're 60, really that self-managed super fund becomes a really good option. At the other extreme, you want to ask people, are you going to own it for more than 12 months? Because some people are out there going to buy a property, renovate it and sell it. Particularly if land tax becomes an issue, because they don't want to pay any land tax, they want to get rid of it really fast. So they've got to make sure they're going to hold it for at least 12 months to get the 50% capital gains tax concession. The other thing I just mentioned there, the 50% discount does erode over time, but still it's 50%. Whether you own it for 1 year, 2 years, 10 years, 20 years, 50 years, it's still 50%. So that's one thing, it doesn't sort of change over time. And we talked about there that you might be retired if you own a property in your own name, which is great for tax purposes, particularly if it's negatively geared, which is great for tax, you get some money back. But then over time, you might want to retire and then think of selling it when your income is much lower. So therefore, it's not going to hurt you nearly as much by selling it in your retirement years when your income is much lower. So it's another good thing to think about how long you're going to keep the property for. Again, we talked about these property developments and unit trust being a fantastic option, but it's all about land tax. So again, land tax, I've done videos on this, I'll show you a link later. Land tax is all the state government tax, nothing to do with the tax office. As a result, each state has different rates and different thresholds, and even they have different year ends. So in Victoria and New South Wales, it's the 30th of June year end. Other states, it's the 31st of December year end. And the thing about land tax, whoever is owning that property at midnight, in New South Wales, it's 31st December, and Victoria 31st December. Sorry, I got that wrong. But in New South Wales, if you're owning a property at midnight on the 31st of December, you pay the land tax for the next 12 months. So if you're doing a property development, you want to sell that property before the 31st December. Or on the flip side, you want to buy it sometime in January, because then you don't have that land tax issue. So when people start, if you're only going to own that for the next 10, 20, 30 years, it doesn't matter. You're up for land tax every year. There's not much to do with it. But in a property development or a property flip, when the margins can be a bit tight, and an extra $10,000 or $20,000 in land tax can make or break a good development, those things are really important to understand the timing of it. Again, if you're doing a property development, it's probably not going to be advisable to do in a self-managed superannuation fund, because the tax office may consider that's running a business. Particularly if you're going to be doing 4, 5, 6 townhouse development or something like that, the tax office say, no, that's running a business, and self-managed super funds just can't run a business. Sorry. So you might just do an easy renovation in a self-managed super fund. But if you're going the whole hog and doing a major development, you need to steer away from a self-managed super fund. We talked about unit trust before, and to be honest, a lot of my clients that are really good property developers, been doing it for a long time, they all use unit trusts. And they know a lot more about property development than I do, so they must be doing something right about that. But like I talked about before, it's all about pooling money. Everyone knows where they stand. The unit trust can go and borrow more money. There's some issues if a self-managed super fund is one of the investors, and then that person, that super fund and their related entities own more than 50% of the units, the unit trust can't borrow money. But if the self-managed super fund only owns less than 50%, the unit trust can borrow money and do lots of things, and then everyone knows where they stand when the development's done. So So if you're doing a property development, you always end up doing a unit trust. That's usually where it ends up. And we talked about whether self-managed super fund is in business or not, and you just can't. But if you're in your own name, you need to consider whether you are running a business, because the tax office are very wary of people doing this multiple times in their own name, doing a development, then selling it quickly, then doing it again, then doing it again. They'll say, hang on, you're now running a business of property development, which has a whole issue of GST, goods and services tax, and also you don't get the 50% discount on capital gains anymore because you're running a business. So again, if you've done it a few times, you might want to look at maybe not doing your own name anymore, doing it in a different structure. So moving on, do you need to borrow? Well, this is important because self-managed super funds, they can do it, becomes very expensive. I normally try and talk a lot of people out of borrowing through a self-managed super fund because it just becomes expensive. Unit trusts, on the other hand, can increase your borrowing capacity. Because what I've found is that when you borrow money in a unit trust and you buy the property in a unit trust, as long as that, and you own those properties long term, it's not through a development, then if that property is looking after its own costs, so the rent's coming in, paying its interest, paying its mortgage, paying all the rates and stuff like that, so therefore it's slightly positive, the bank will put a fence around it and say, listen, let's park that over there, and then all of a sudden the loan over there in the unit trust doesn't count towards your borrowing capacity. So therefore you go back to the bank, borrow another $1 million, put in a unit trust, buy the property in a unit trust, let it become positive, go back to the bank goes, lend you another $1 million. So it actually rapidly increases your borrowing capacity if you're borrowing things through a unit trust. I like unit trusts, even if you're just the sole unit holder of that unit trust, because you get your land tax exemptions, still get the stamp duty exemptions, you get the borrowing capacity, you don't get the negative gearing, but hopefully it's positive. The big thing there though is that whole principal place of residency exemptions and capital gains exemptions and stuff like that. But if it's a pure investment, particularly a pure development opportunity, unit trusts are really good. We talked about there, they don't have the negative gearing benefits if you are borrowing in a unit trust, but it does give you that extra borrowing capacity, which is really cool. Another question I always like to ask is, do you have other investment properties? And the reason I do ask that question is because you want to know how sophisticated the person is. If they've been there and done that a few times, it's easy to talk to them because they might have already learned a few tricks along the way and some things like that. Plus the borrowing capacity in your own name may have already been exhausted. You might already have a couple of investment properties. You're going back to the bank for a third one. They go, sorry, you've just got too much borrowing as it is. So maybe a unit trust is the way to go from then on. And again, the land tax thresholds we've talked about land tax a lot, becomes a big issue. Another question I talked about is how old you are. Well, we talked about this one with, how long you're going to own it for, because if you're buying a property now, you're 40, 50, 60 years old, the chance of you selling that property when you're in retirement age is probably very high. So therefore the whole self-managed super fund becomes an option. But if you're only like 25, 30, you can't imagine holding that property until you're 60. Like you just can't. So therefore, maybe the whole self-managed super fund isn't an option. So we have to sort of cross that one out, things like that. But it's always important to find out how old people are when they're sort of making these decisions, because it affects how they set it up. And we're talking about when you sell it, if you're in retirement, when you sell it, it's a lot easier to pay less tax. And the borrowing ability. If you're 55, 60 years old, going to the bank to borrow money, it's a bit harder because they're trying to give you a 25-year loan or something like that. They go, hang on, you're going to be 75, 80. How can you afford to make these repayments and things like that? Last question is, how many people are involved? This is important because we talked about unit trusts, we talked about self-managed super funds. Like in other videos, I've talked about self-managed super funds. You have up to 6 members, and they don't need to be family members. So all of a sudden, that could become a place where you can pool money instead of borrowing it. A self-managed super fund could be set up that goes into a unit trust with other people putting their own money in. So if someone says, yeah, I want to buy an investment property, yeah, there's a number of us, mum, dad, my cousins, my brother, things like that. All of a sudden it becomes a bit more other options. Because with multiple people, you got to understand if, like say there's William, Richard, Anita and Derek. 4 of us want to go and buy an investment property. And we all decide, yeah, we're just going to own it as tenants in common, 25% each. Nice and easy. But that means you need 4 people to sign the mortgage documents and 4 people to sign anything to do with the property. And then one day, William might want to leave, or he might get married and another person comes. It's very hard and clunky to change these things. But if the property is owned by a family trust or a unit trust, where the unit trust is a separate legal entity because it's got a company as the trustee, it just drives the property. And all the unit holders are out the back. He doesn't care who the unit holder is. That could change on a daily basis. It doesn't matter. So it makes it a lot easier to manage things if you're in like a unit trust or a family trust structure. However, if one of those people though want to go and live in the property, then there's issues. Because, and this is this funny rule that only came in last year, for land tax purposes, let's say there's a property and there's 4 people, William, Richard, Anita and Derek are 25% each owners of the property. But we're really buying it for William, my son. And he goes and lives there. Now, if he owns 25% of it, he gets the land tax exemption as a primary place of residence because he's living in it and he owns a minimum of 25%. But let's say William owned 20, Richard owned 20, Derek owned 30, and Anita owned 30. So and William lived in it, and he only owns 20%. We don't get the principal place of residency land tax exemption because the person living in there doesn't own 25%. So what would happen is William and Richard would both have to live there and their combined ownership would be 40%. So that's really important to, particularly if you're looking at buying a property for your children, you need to make sure that they've got at least a 25% ownership of that to get the land tax exemption. Now, obviously, buying a unit trust or a company or a super fund or a family trust, you don't get the land tax. Oh, you do get the land tax threshold, but you don't get that exemption. Again, what's talked about here, the unit trust offers that easy continuation of ownership. It's driving the bus and doesn't matter who the unit holders are. So again, we've got to the end of all those questions. I've been going for an hour already. I know I'm really sorry to go on for so long. Here's a bit of a summary. You can pause the video and go through those things here. We've sort of killed all these different options here. What's good, what's bad. But at the end of the day, there's no right or wrong answer with this one. So my final thoughts on this one, because people want to watch this video and say, all right, Derek, this is really good information. But at the end of the day, just tell me, I want to buy a residential investment property. Whose name should it be in? That's all I want to know. Now, my default and my general advice to people, particularly if it's their first investment property, just to buy it in their own name. It's simple, easy to borrow. They get the taste of it. They get the principal place of residency exemption for land tax. They get the capital gains tax exemption if they ever live in it. It's just so much easier. So that's always my general advice to most people. They'll start talking about, oh, what about asset protection? Oh, don't worry about it. You're not going to get sued. Particularly if you're a business owner, you've got plenty of asset protection with your business and companies and stuff like that. The second thing is, if they're telling me they're doing this for tax purposes to save tax because their sister doesn't pay any tax because she's got 5 investment properties, well, have a rethink about that one. Don't just do it for tax purposes. Do it for sound investment purposes. That's my second advice. And the third one is that really any type of property development that you do, it's a no-brainer to do it in some sort of unit trust. All the smart people I know do it that way, and they do it for a reason. Particularly if there's multiple people involved, but even when there's only one person, there's still plenty of reasons. But as long as you don't ever want to live in it yourself, because that's always the downside. And again, family trusts do tick lots and lots of boxes. So I do like that one as being a good option to buy investment properties. But land tax always ruins the calculation. So always do it with the land tax calculations involved in your numbers. Now, there comes a point when particularly you've got 2, 3 or 4 properties in your own name and you don't have that threshold anymore, or you're buying in Victoria, for example, you don't get a threshold at all. In most cases, family trusts work really well to buy the property, but you got to make sure that that's property that's going to be a pure investment. You're not going to live in it yourself, so therefore you're not going to throw away the capital gains tax exemptions and land tax exemptions and things like that. All right, well, they're my final thoughts. Now, my last thing here is I've done videos in the past. Go back and watch those. Like this one here is, can my self-managed super fund do a property development? Well, it can, but there's lots of rules involved with that one. Land tax, I did a really detailed discussion on land tax and how it works and how each of the states, calculate it and pay tax on it. Another one, which is did this ages ago actually, probably 5 or 6 years ago, is can you buy a property in a family trust? Well, you can, and it is a very, very good option, but it talks about the whole land tax issue and things like that. All right, well, I'm going to leave it there. This has been a long video, but a video I've been dying to do for a long time. I will be doing another one on buying investment property for commercial purposes, because that has a lot of different implications regarding using it yourself in your own business and things like that. All right, I'll leave it there. Make sure if you want to give me a call, ask any questions. There's my website, www.12.com.au. info@12 is the email address, things like that. So, all right, thanks very much for watching, and goodbye for now.